So all the income, like contributions, interest, rent, dividends, it's all taxed at 15%. Capital gains is taxed at 10%. If it's on a pension phase, it's 0. So you know that. This is the best structure ever that you can't find in anywhere in the world. Australia is a tax haven country. Okay, just to explain what I just said to Warren about the money going into the super, the maximum, this is what we call the concessional contribution, is what you can claim for tax deduction. So if it's concessional contribution, you put 25,000 in, say you have a business and you contribute 25,000 into super, your business can claim for tax deduction. So if you're in the company situation, it's 30%. So company can claim 25,000, so you're saving 30%, but you only pay 15%.
Is that on top of, let's say in your company that you earn $300,000 income, you pay that as a wage to yourself, and you take it in compulsory contributions. The 25,000 is on top of the compulsory contributions.
No, including at 9%, yeah, including.
That's lean.
Yeah, and you can't go over, because we have clients that went over and they have to pay the excess contribution tax. They really hit you with assessment. It's 46.5% of any excess. Yeah. So be careful, you have to watch out this. They restrict that. And this non-concession is what we'll just talk about, is like, you can put 150,000 non-concession every year. Right? But say in 1 year you make a capital proceed, like you sell something and you make 450,000 and you want to put that into your super. You can, if you're under 65, you can push the, it says forward rule, like you can push the 2 years, so you put 450, so for the next 2 years you can't put any. And if you're husband and wife, you got it up to 900,000. Okay?
Non-concessional, you're saying it can't be a tax deduction?
No, it's not tax deduction. So if it's not tax deduction, the super fund doesn't have to pay the contribution tax. So there's no 15% tax because it's a non-concession. Okay? And then after that, you know, after your preservation age, or when you decide to retire, or 55, after 60, then there's all tax-free. Assets protection. We're talking about bankruptcy this morning. If you put the money into your super, you're protected. The bankruptcy trustee can't access to the super. But it depends on when you put, they can have that callback. You know how Warren was explaining about bankruptcy, about callback and things like that? The 2 years, 4 years and all that. So they still can, if they see you like put excessive in or something, you know, you can. So, but it's well protected. This is what I'm saying, the ability to transfer the leased shares or commercial property into the super fund. I'll give you, this is a true, my client's situation. His full name is Jekyll, but I just put Mr. Jekyll. When he came to me, he was age 62 already, but he retired when he was 56. That was 6 years ago. And then what happened is that he owned a commercial building. Very good man. He collected about 80,000 a year. He got other income as well. So his tax rate is what, 46.5%. He did not know about his strategy, right? So he's been paying tax about, just on that rent alone, he paid 37,200 each year. So he has been paying for 6 years. So all out, he paid 223,200, which is, I could not get that back for him because it's already gone to the government. But what I can help him is the future, okay? So what I did was that we transferred that commercial building into the self-managed super fund, and because he's age 62 already, how much tax he paid? How much tax he saved? So he saved 37,200 a year. So for the next 20 years he lived, how much is that? 744,000. Is that a lot of money?
You just basically giving him a decent living expenses compared
exactly.
to living on.
And just a little tweak, you know? Like when you look at it, you can see, I wish you came to me, you know, 6 years ago. I've been able to save you that money. I know you love the government, but you don't have to be that generous. Yeah, so this is about financial education. When you know, you're aware. It may not happen to you yet, but you're aware that you be, So it's like how are you ability to invest in property even if you don't have any spare money? Do you guys know what's the rule of 72?
Yeah.
Yeah. So it's very easy to calculate. So if you estimate your return is going to be, say, 6%, and you want to know how many years that is going to be double, what you do, you get 72 divided by 6 equal 12 years. So that means that the piece of property will take 12 years to say if you buy it today for 400,000, in 12 years time, because the return we estimate to be 6%, then it's going to be 800,000. If you estimate it, it's going to be, say, well, I know you don't have the calculator. Say people say 7%. How many years would that take? 10. Yeah. So 7 years, 10. So if you estimate it's going to be 10%, so 72 divided by 10 is going to take 7 years. Do you get it? So that's how you work it out, how they double up in value. So in this example, I give you, so I'll say for example, you buy a property for 400,000. And then you know that I told you you're going to retire in 12 years time, right? Probably not, because I love my job. What am I going to do, you know? Anyway, so it takes 12 years, this one's going to become 800,000. That's this property, okay? So you're clear. So this is how quickly you can work it out, the rule of 72, okay? The fact that you can use other people's money to invest, it will... Do you all understand what's leverage mean? Yeah, so leverage means like you're using very little of your money or little effort and you have a big result. Like you're using, you know like now my example this morning, like if I listen to my uncle and I pay $5,000 to get that piece of property, now I can make like, 460,000. How much, like I only use little money, I get big result. So it's good to use other people's money to invest. And with the government having the contribution caps, like you know how we say you can only put 25,000, 150, then leverage, it's the only way, I would say, to double up, to really fast track your investment. Would you agree? Yeah? Yeah. But you have to do it, but everyone loves property because if you invest in residential property, you know everyone, like the first thing I came to Australia, we have to look for a place to live because we have to have something, to cover us. So it doesn't matter, like you've got migration coming, you've got people born, you've got young kids have family, everyone needs a residential property. The first thing they need is their family home. So if you invest in residential property in the good, you're not going to go wrong, I don't think. You know what I mean? At least you've got the property there. Okay? So, the other thing is like, okay, you might be thinking, I've got a dream home, I want to live somewhere when I retire. You can start planning now. You can say, okay, I'm going to buy a house there. At the moment, I'm not going to live in there yet. I'm just going to use my self-investment fund money to buy it, and then I'm using the 9% contributions, that the 9% the employer give it to you, plus the rent, that will be enough to cover the interest. So you pay that off. And then by the time you retire, you can sell off the main resident, the one that you live in, and then you can transfer that, like after the pension phase, remember I say no capital gains, you transfer that house into your name and you live in there. How cool is that? Yeah, so you can live your dream home. You just plan for it. Do you understand what I'm talking about here? Trying to do it. What I mean is like, you invest in the property that you want now, the area that you want, maybe near the water or whatever, you get your super funds to fund it. And then by the time you retire, because you're going to have a house, the house that you live in, you're going to sell it, because if you sell your main principal resident house, there's no capital gains tax. And if you sell that house that you transfer to yourself, there's no capital gains tax. So you got the money from your family home, and you got the property that you want to live in.
So you say you transfer it out of the super fund?
Yeah, you have to transfer it into yourself.
And there's no transfer costs?
Oh no, there's a stamp duty, yes. There's a stamp duty but so, do you know what I mean?
Yeah. No taxes and all that.
Yeah, but there's no capital gains tax. But yes, there is going to be a stamp duty, yeah. Okay, so in this example, I put like, assuming that we buy a property for 400,000, and just to summarize, like, say we buy 2, and we borrow like 80%, right? By the time, at the end of the 12 years, the property is going to be worth like 1.6 mil, like 2, because 800 times by 2, like it's about 1.6. So I take away the loan that I'm still owing. So I made 1.147. I still not quite achieving my goal because my goal is 1.2 million. But I'm going to have some money into shares, into cash, into other things. So I added up, I should be able to achieve that, you know, like for 2 property, right? I should be able to. But if I say I buy 3, right? Then what I can do is that if I have 3 property, I can sell 1 property, pay off all the debts, then I own the 2 property out, right? Then I collect the rent, I still can achieve my goal. You get it? So property is like a vehicle for us. You're excited? You're not excited with this strategy? Yeah. So, okay, so what I mean is like, so now, after you pay off, like, if you have 3 property, after 12 years, assuming it's 6% return, right? Then you're going to have a net worth of 1.721 in your super fund. You achieve your goal by just having the 3 properties. So first, we have a goal first, and say how I'm going to do it to get that. So by just focusing on that, simple, make things simple, you achieve it. Just keep things simple, and you get onto your life and do the stuff that you love to do. Let them rent it out, and you know what I mean? And easy, right? So that's what I mean. So I think maybe what we do with.
So you're saying that you're using your, say you're employed, you're using your...
The fund, yeah. So in yes.
Super fund, but what if it's not?
Okay, what in my example here is assuming that I have 200,000, even if you don't have any money in the super fund and you have some equity outside, like you have property outside, you can refinance your equity and get that money available and then lend it to your super fund. So you don't have, say for example, you start with just let's say that you start with 0, right? You got nothing in your super fund. So say in your self-managed super fund, you have 0, got nothing. But you have property outside, maybe, you know, worth of say 500,000. Say 500,000, right? It's the equity available. What you can do is that you can refinance that, so you can get 80% of that. You can get 400,000. Right? You can lend that money to the super fund, and the super funds can use it as a deposit to buy that property using the Bear Trust, which is what we're going to do. Is that when we come back, I'll show you step by step how you do that. So you can start with 0. But if you have already got money in there, then you use the money in there as a deposit to buy that. And then, so in a way, because you know how the government restrict you, say you can't transfer your residential property into the super fund. So, it's okay, you transfer the equity. It's the same. Even better, because you have to pay stamp duty.